let's do some questions on equity. A corporation declared a 10% stock dividend on 15,000 shares outstanding of $5 par common stock when the fair value was $10 per share. Which change in the corporation's stockholders' equity accounts is correct? So, best way to approach this is be familiar with a lot of the journal entries that have to do with the declaration of dividends, the paying of dividends, be it cash dividends or property dividends. Here is a pretty good listing of all of the dividend journal entries that you might see. So in this case, let's take a look. We've got a stock dividend. So stock dividend is going to be considered which type of these? I'll give you a second to think about it. All right, if you said that it was a property dividend, awesome. So stock dividends are property dividends. They're actually treated, tax purposes for capital gains, but we'll get to that in reg. So, all right, we see property dividends, and we see, okay, it's a declaration. So declaration right here, property dividends right here. Let's see, it's going to be here. Now, which change in the corporation's stockholders' equity accounts is correct? We've got retained earnings, common stock, and additional paid-in capital. Well, a couple ways to do this. I don't see any of those other accounts other than retained earnings here. So that's why I would say retained earnings. Another thought on this, it's not going to affect common stock. Even if you had a cash dividend, that's not going to affect common stock outstanding. What would affect common stock outstanding or anything at all like that is if you issued more shares, if you bought back more shares, whatever that might look like. And it's not going to be APIC, which generally is going to be plug or dealing more with treasury shares. So that is why I'm going to say final answer, letter C, is retained earnings decreased by 15. Just to kind of check with the math on that, so how the math would work is, well, we have 15,000 shares. 15,000 shares times 10%, what does that get you? That gets you 1,500. And then we are going to use 1,500 times the $10 per share, the fair value, and that's going to be our amount why retained earnings is decreased. And let me talk about that a little bit more is, well, what's going on here? We're giving a stock dividend, meaning we're giving away more stock instead of cash. So if I hold one share of Apple, Apple declares a stock dividend, that means they're going to give me maybe another share of Apple. And that share of Apple is going to be valued at fair value. It's not going to be valued at par value. It's going to be valued at whatever the market says a share of Apple's worth. So that's why we're going to account for it using fair value. And yeah, the 10% is essentially saying like here is like 10% of a share. So you would get, if you have one share of Apple, you'd get 10% of one share of Apple. Final answer, letter C, retained earnings. Next up, retained earnings is decreased when a company declares a cash dividend. Well, one of the few questions that kind of just gives you a fact about accounting. Which date does this decrease take place? All right, so a good way to think about it, and I'll say this a lot, what makes sense? When is this effective as of? So if I am holding a share of stock, when do I need to be holding that stock to receive the dividend? Well, it's definitely not going to be the payment date because you need to, from the shareholder's perspective, it needs to be spoken or stated, I'm specifically avoiding using a certain word here, that you're going to receive that cash dividend. Decreasing retained earnings is not going to happen on the record date. It's not going to happen on the receipt date, but it's going to happen on the declaration date. So on the declaration date, that's when you are going to, and actually here, we can go back to our chart. Date of declaration, cash dividends, you see we are going to reduce retained earnings. So we're reducing an equity account, increasing a liability account for dividends payable, and that's because we're going to have to pay this out on the payment date. Next up, Harrington Company initially authorized 50,000 shares of its common stock with a $20 per share value. In year 2, Harrington issues 40,000 shares of the stock for $39 per share. Later in year 2, Harrington buys back 10,000 of these shares for at the same price of $39 per share and retires those shares. No other equity transactions took place during year 2. What amount does Harrington report in its common stock account at the end of year 2? This is one of those, I like to call them story questions, where it's just a story and you got to keep following each step along the way. So our final thing we're trying to find, keep hone in on that, because it might be asking the amount of shares outstanding, the value of the shares outstanding. So this one's asking, what do we report in its common stock account? How much common stock in dollars does Harrington have outstanding at the end of the year? One thing I want to bring to your attention, authorized 9 times out of 10 is going to be distractor information. We don't care. I mean, yes, stock has to be authorized to be issued, but it doesn't matter for our purposes. What we have is only 40,000 issued. So 40,000 is going to be a good dollar amount to use. Let's start with 40. What do we have next in our story? What's the next step in our story? Well, we have 10,000 of these shares were bought back. And where did that go? Give me a second to think about that. It went to Treasury. So at the end of the year, we have 30,000 outstanding, meaning 30,000 shares in the capital account, in the common stock account. Okay, and then we initially authorized the shares with a $20 per share par value, and we are going to then take that par value of $20, multiply it by our 30,000 shares, and that is going to be our final answer here in terms of the amount that we have in the capital account at the end of year 2. I'll give you a second to do that math as well. Going once, going twice. All right, final answer is $60,000. So again, keep in mind, what are we looking for here? Is it the amount of shares? Is it the amount of dollars? That is going to be what's in the capital account at the end of year 2. Cool. Awesome. 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 Last, we have Randy Company had the following account balances at the end of year 5. We had sales of 300, cost of goods sold of 100, salaries and wages 50, rent expense 30, advertising costs of 45, fixed assets purchased for 40. What is your net income? And why is this being asked in the equity section? Well, one simple answer. How do you increase your retained earnings? You earn some net income. The net income goes into the retained earnings. So that is why we're being asked this here. Let's calculate net income. What's a good place to start? All right, if you said sales, good. Because at the end of the day, net income is simple. It's sales or revenues minus expenses or costs. So we have 300. Next, and a pretty obvious one, is going to be subtracting out cost of goods sold. Because how do we make that revenue? Well, we have to sell. Pardon me, we have to buy things to sell those. Next, salaries. We need to pay employees to make these goods. We need to pay employees to do accounting, marketing, etc. We also have rent. These are all of the specific and necessary expenses, and also these are the ones in the income statement. Anything you see here, think, is it on the income statement? We also have advertising. And then last, fixed assets purchased. Well, no, that's not going to be included. That is going to be reflective of somewhere else. Fixed assets purchased, those might fall under another category here. So we would be double counting those if we included them. Go look on the income statement. We don't see a line for fixed asset expense. We would find that under somewhere else. So cost of goods sold, possibly. So final answer, do a little math here. Give you a second. Final answer, $75,000 for net income. Awesome. Some good questions on equity, and I'll see you guys next time.